Okay, Netflix. This is probably a good time to mention that you're going to go through a bear market every few years. We're seeing one there in the '08 period, and that's when bases are formed. But in most cases, you're not going to be able to tell until you get in and along the bottom. And sometimes in the bottom in the market, it has three waves down, and then at the bottom, it undercuts a little bit, and it rallies up a little bit, and then it undercuts a little bit again, and then it turns and starts to really come out of it. So you get faked out a little bit along the bottoms. Usually you're having three waves down. The third one usually is the worst, and then it'll doodle around a little bit, and that's where the bases start coming up the right-hand side and beginning to form out. This one breaks out. And the first stock to break out when you start coming out of a bear market is usually a giant leader, because they've been held down and suppressed and knocked down for 9 months or 12 months or whatever. And finally the pressure's off, and these stocks, meanwhile, have been showing good earnings and everything was there, and they would have run up a lot if it hadn't been for the market being so poor. So these are the ones that'll bounce first and fastest. Now this brings up another point. You cannot have personal opinions about what you think of the general market. Let's say you're going through this correction that went from December '07 down to March '09. You could say, boy, the economy's lousy and the market's lousy and the government doesn't know what it's doing and this is happening and that's happening and there's all kinds of news out there that's questionable. Well, that's your personal opinion, and you're not paid very much for that in the market. You're paid for analyzing what is actually happening at the time and recognizing when it starts to change, and you have to change with the market as it changes. It's very normal, if you're an intelligent person and highly educated and all, that you'll have opinions about the market. And after you go through a period like this of a year and a half of the market just going down and down and down, a lot of data is going to be pretty poor, and you may be convinced that, boy, the economy really isn't right yet, and I don't like the market, but meanwhile, the market hit bottom and it's turned, and the big leaders are coming up fast. So you've got to learn to interpret the market and go back and forth with it and not get too fixed in one set opinion. The market can turn on a dime. It can look terrible for the prior 3 or 4 weeks, and all of a sudden, the next week, it's hit bottom and it's up and going, and the stock is at a buy point, and either you miss it or so you want to catch the stocks that are breaking out first. And Netflix was one example. It does run up and build a whole new cup with a handle. So if you did miss the first one, you want to keep watching it, and eventually you'll get a second chance. So there's a classic one that occurred in the September '09 quarter. It breaks out of that. Along the bottom of that cup, you saw a lot of close closes. In other words, 5 weeks of tight closes and 3 weeks of tight closes. The stock was being supported underneath the moving average line and being bought. So in addition to recognizing, gee, there's a cup with a handle, you can go through week by week by week, looking at every week in that pattern and seeing how the volume handled itself, seeing did you get support at certain points, did you have areas where suddenly it started moving tight, as this one did along the bottom. You had 5 weeks of tight closes and 3 weeks of tight closes. You're doing two types of research: recognize the pattern, but the other is go on a week-by-week analysis to see the supply and demand so that you can see, yes, this thing was supported several times during that correction period, and it did what it should do. And you put all these pieces together because you get a little clue from each one, and you buy when this stock is breaking out. Realize, too, that it isn't enough just to buy it when it's breaking out. Let's suppose that you're coming out of a market long correction, and this is the first stock to break out, and you're buying it. Well, you don't want to foul it up. Let's suppose that this stock is going to go up 5 or 6 times in price. You've got to have some very strict rules, not only to buy it right, but to sit through the first correction and add to it at other points and not get thrown off. You can't guess at it. You can't go by how you feel. You've got to have a bunch of strict rules to try to keep you in. Netflix actually broke out, it looks like, around the 46 area, and it went to 300. So you want to hold this stock through all of these pullbacks and all these corrections, and as many as possible. Maybe you have to sell it once, but you get it bought back. You want to capitalize on that whole move. So you have to have not only rules how to recognize a pattern and buy at a buy point, but you got to have rules that'll say to hold for certain reasons, and other times to add for certain reasons. You're not winning the ball game until you get all the way through this situation. And how many times have you bought a stock and you made a little bit on it, but you didn't handle it right and you got thrown out? You want to have on these big examples of huge winners some rules that can keep you in for the majority of that move. You want to get the heart out of the watermelon. You don't want to just get the few seeds and a couple of bites here and there and foul it up. And that's not easy because, look, you had not only the base, you had another sharp correction, and another one. And eventually, one of those sharp corrections is the top, and you've got to recognize the difference. So you buy the first couple that handle, you add to it a little bit, you go down, and here's your first shakeout. And boy, is it bad. It drops from about 61 to 49. That's a 12.20% correction. Odds are you're going to probably get scared because it goes down week after week after week. 1, 2, 3, 4, 5, 6, 7, 8, 9, 8 out of 9.5 weeks, and about the time you sell, it turns and bounces real fast, probably because an earnings report came out that was huge. Well, let's see. Earnings report is out. Add on gap at 61 on huge volume, a 602% increase above average on a daily chart. So the earnings came out, and they were so big that you got a 602% increase above average on a daily chart. So that stock turned from 49 and zoomed. It probably gapped up like crazy. Well, it gapped to 61. That brings up another rule, and you learn this through experience. Don't be afraid to buy on a gap up. If it's a gap up and there's a big reason, the stock may be telling you, wow, this is a great stock, and some big people are just putting millions of dollars into it, and they don't care if it's up 15 or 20%. They're impressed with the earnings report that came out or something else that's happening. You got to learn that just because it gaps up doesn't mean that you can't buy it. You'll see some stocks that break out and they gap up 3 points, 5 points, 7 points, whatever. Of course, if it's a lot, then it's more scary. But if it's a lot on the gap up, maybe that's because there's a lot that's happening there and somebody really wants it and they're going to pay up for it. Okay, so you get the gapping up buying at 61 on the huge volume. Also, it says down there, don't sell as that stock closes the week in the top half of its price range. That's a sign of support. In other words, that was the third red week from the bottom there in the March 10 quarter we're talking about. So that was the second week down that it closed in the upper part of the week, and it was on big volume. So that's a scary part, but you see what happened, and if you were scared and you went out at 50, it only went to 300. So realize that on the way to 300, you're going to get 2 or 3 scary times, and you better be able to interpret what actually is happening. Is it somewhat normal? And the fact that that closes in the upper half with the volume picking up is significant. Now, the market is correcting at the time, so it drifts down for a couple more weeks, shakes everybody out, and then it takes off and goes from 50 to 300. So all I have to do is ask, has anybody ever been shaken out of a leader? And you know what I'm talking about. You have to be prepared for those. They're going to happen. You need some rules, and you need to be able to interpret things. And it also is why it's important that you start exactly right. If you start exactly right, you probably have a little bit of a cushion. But if you chased it, now you're going to get thrown out in the correction. So you got to buy right for the right reason, and then you got to defend yourself. And the red line helps a little bit because sometimes you work in and out and around it. Most of these big leaders will pretty much follow that line all the way up, a little bit above it or a little bit below it. So shake out, run up in the 60 area where we gap up and take off and run 8 weeks in a row. You build a little double bottom. You can buy that coming out of the double bottom, or you can use the Livermore rule of if you undercut the low, the first bottom, and you come back up through it, by 3 points on a $30 stock, that you establish a buy point. Now, we adjusted the 3 points to 6 because it was a little bit higher price stock, but that's based on a rule again. My point is that the more rules you have, that you'll do this because of this rule, you'll do that because of this rule, and it's much easier to have rules to follow than, oh, how do I feel now? Oh my gosh, it's down 7 points today. Now what do I do? Well, that's no system, that's no rule. That's getting scared, and you have two emotions in the market, and that's hope and fear, and the problem is you hope when you should fear, and you fear when you should hope. So you can't go by how you feel. You got to have rules, and the more rules you have, the rules will probably save you and allow you to capitalize on a stock rather than just get a little bit of it. Well, we ran up to the double bottom, and we talked about undercutting that and buy. Then we bounce a little bit later off the line in the December 10 period, and we run up, and now at some point we're going to get to one of these periods where we say, okay, sell it. So after you've had an extensive run up, and then you go down 2 weeks straight down to the line, then 2 weeks straight back up, and then go into new high ground, that's not a base. 4 weeks isn't a base, and 2 weeks straight down and 2 weeks straight up is not a base. And we're saying sell. Now, if you didn't sell there, the volume picks up like mad the first week when it goes into new high ground. And the third week, it's huge. And at some point, you see, I got to get out of that. If you didn't pick up on the first signal, you got the second one or you got the third one.